What is the must-read trading manual before market open, geopolitics and pivot levels? Good morning, traders across the screen. Welcome to Market Meridian. I'm your pre-market guide host Eric. Today, we're not going to talk about empty words. We'll only cover the most core, critical pre-market insights that can directly affect your trading profits and losses, geopolitical gains combined with key technical support. Every point may be the deciding factor for your trades today. Whether you're a day trader focusing on intraday trading, a swing investor paying attention to the S&P 500 trend, or a long-term investor focusing on energy and defense sectors, you must listen carefully to the content of these 15 to 18 minutes. Because we will deeply analyze how US-Iran tensions reshape the opening pricing of energy and defense sectors, accurately lock in the make-or-break level of the S&P 500, review the overnight global market liquidity guidance, and finally provide actionable trading manuals and risk control advice to help you avoid traps and seize opportunities. Before we officially start, let's sync a core premise with everyone. For today's US stock market opening, geopolitics is the absolute dominant variable. Bar none. Almost all fluctuations in global markets overnight and all adjustments in asset pricing have revolved around the latest escalation of US-Iran tensions. Many traders may think that geopolitics is far from them, nothing more than a few reports in the news, but in fact, it has directly transmitted to crude oil prices, defense stock trends, and even indirectly affected the support levels of the S&P 500 and global liquidity, all of which are closely related to every trade we make. Therefore, today's content is divided into 4 core parts, from macro to micro, from analysis to practice, to help you sort out your thinking step by step and make full preparations before the opening. First, let's enter our first part, the macro pulse. We will focus on interpreting the overall sentiment of the overnight global market and the core impact of US-Iran tensions on the macro market to help you grasp the general tone of today's opening. Before the opening bell of the US stock market rings, the global market is in an extremely unstable balance, a balance that could be broken at any time by further escalation of geopolitics. I wonder if you have paid attention to the performance of the overnight global market. Both the Asian and European market showed a clear risk-off tendency, which is what we often call the risk-off mode. In the Asian market, the Nikkei index closed slightly lower, and the Hang Seng index fluctuated downward. The core reason is the market's concern about the escalation of US-Iran tensions. Funds have begun to withdraw from risky assets and shift to safe haven assets such as gold and US Treasuries. After the opening of the European market, it also came under pressure. The German DAX index and the French CAC 40 index both fell to varying degrees. The energy sector strengthened against the trend, while the technology sector performed weakly. This differentiation is a direct reflection of market sentiment under the impact of geopolitics. The most reflective of the impact of geopolitics is undoubtedly the crude oil market. During the Asian trading session, Brent crude prices once broke through key resistance levels, reaching a high of fill-in specific level, e.g., $88 per barrel. Although it pulled back slightly afterward, the overall increase was still obvious. Many traders will ask why the escalation of US-Iran tensions directly affects crude oil prices. Here, everyone must understand the core logic. Iran is one of the world's major crude oil exporters, and the Strait of Hormuz, as the world's most important crude oil transportation channel, carries nearly 30% of the world's crude oil transportation volume. Once US-Iran tensions further escalate and the navigation safety of the Strait of Hormuz is threatened, there will be a gap in global crude oil supply. Under the imbalance between supply and demand, crude oil prices will inevitably rise, but everyone should note that the rise in Brent crude this time is not only a risk premium brought by geopolitics, but more importantly, it has re-anchored market inflation expectations. As we all know, crude oil prices are an important leading indicator of inflation. A rise in crude oil prices will directly drive up the prices of a series of products such as refined oil and chemicals, thereby pushing up the overall inflation level. the rise in inflation expectations will in turn affect the direction of the Federal Reserve's monetary policy. If inflation remains high, the Federal Reserve may delay interest rate cuts or even maintain the current interest rate level, which is undoubtedly a pressure on the stock market, especially for interest rate-sensitive technology sectors. In addition, there are some noteworthy signals in global liquidity overnight. The scale of the Federal Reserve's overnight reverse repurchase has decreased slightly, which means that the idle funds in the market have decreased and liquidity has tightened marginally. At the same time, the US dollar index strengthened slightly, breaking through the 104 mark. On the one hand, this is because safe haven sentiment has driven funds to flow into US dollar assets. On the other hand, it is also due to the market's adjustment of expectations for the Federal Reserve's monetary policy. The strengthening of the US dollar will in turn suppress dollar-denominated commodities, including crude oil and emerging market assets. This is a point you must focus on in today's trading. To summarize the core points of the first part, the overnight global market showed a risk-off sentiment. The escalation of US-Iran tensions pushed up crude oil prices and re-anchored inflation expectations, while global liquidity tightened marginally and the US dollar index strengthened. These macro signals will directly determine the overall tone of today's US stock market opening. It is likely to open lower, and market volatility will increase significantly. Everyone must be mentally prepared. Next, let's enter our second part, S&P 500. In this part, we will focus on interpreting the key support and resistance levels of the S&P 500 to help you judge the direction of today's index trend, lock in the make or break level, and avoid the trap of chasing ups and downs. After talking about macro sentiment, let's focus back on the US stock market itself, focusing on the S&P 500 index. For day traders, the trend of the S&P 500 almost determines the trading rhythm of the entire market. Today, the key support level of the S&P 500 is the make or break level we must focus on, because once this level is broken, the market may usher in a new round of sell-off. Currently, the S&P 500 index is hovering around the key support level, fill-in specific level, e.g., 5,200 points. This level is critical for three core reasons. First, this level is the lower edge of the recent shock range of the S&P 500 and also a psychological support level of the market. It has been tested many times but failed to break below effectively, indicating that this level has strong buying support. Second, this level is exactly close to the 50-day moving average. As an important indicator of the medium-term trend, once the index breaks below the 50-day moving average, it means that the medium-term trend may turn from bullish to bearish, triggering a large number of trend traders to stop loss and leave the market. Third, from the perspective of trading volume, the trading volume near this level has increased significantly, indicating that long and short sides are engaged in fierce games here. Once one side gains an advantage, an obvious trend will be formed. Therefore, after today's opening, the first thing you need to pay attention to is whether the S&P 500 can stand firm at this key support level of 5,200 points within the first 15 minutes after the opening. If it can stand firm with moderate volume expansion, it indicates strong buying support, and the index may rebound. The first resistance level for the rebound can be fill-in specific level, e.g., 5,230 points, and the second resistance level is fill-in specific level, e.g., 5,250 points. However, if the index directly breaks below 5,200 points after the opening and fails to stand back above this level within 15 minutes, we will see accelerated liquidity outflows. A large number of stop-loss orders will be triggered, and the index may drop sharply. Here is an important reminder for everyone: the deeper psychological defense line below is fill-in specific level, e.g., 5,150 points. This level is the previous low of the S&P 500 and also an important support level. If this level is also broken, the index may further drop to around fill-in specific level, e.g., 5,100 points, or even lower. Therefore, in today's trading, the two key levels of the S&P 500, 5,200 points, and 5,150 points, are the two key points we must focus on. They directly determine the overall trend of the market today. In addition, there is a very important trading skill that everyone must remember. In the context of a gap-down opening, the first rebound is often short covering, not a real return of buying pressure. Many traders rush to enter long positions when they see the index rebound after the opening, but they often get trapped at high levels. Because the rebound brought by short covering is often short-lived and weak. Once short covering ends, the index is likely to continue to decline. Therefore, if there is a first rebound after a gap-down opening today, everyone must stay calm and not blindly chase up. It is best to wait for the rebound to lose momentum before considering whether to enter short positions. If the index stands firm at the key support level and there is continuous buying inflow, then consider entering long positions. This can effectively reduce risks. To summarize the core points of the second part, the current key support level of the S&P 500 is 5,200 points, and the deeper support level is 5,150 points. The performance in the first 15 minutes after the opening is crucial. The first rebound after a gap-down opening is likely to be short covering. Do not blindly chase up, and wait for a clear signal before entering the market. Next, let's enter our third part, Sector Alpha, Energy and Defense. We will focus on interpreting the trading opportunities and risks of these two core sectors, energy and defense, under the impact of geopolitics, helping you find today's alpha opportunities while avoiding potential traps. As we said in the first part, geopolitics is the absolute variable today, and the two sectors most affected by geopolitics are energy and defense. One of these two sectors benefits from the rise in crude oil prices, and the other benefits from the order expectations brought by geopolitical conflicts. They are the most likely sectors to have structural opportunities in today's market, but at the same time, they also hide considerable risks. Everyone must view them dialectically. First, let's look at energy stocks. With the escalation of US-Iran tensions, the risk of global crude oil supply disruption is being priced in by the market, and oil giants, as the core of the crude oil industry chain, are likely to become a safe haven in the market. Because no matter how geopolitics escalates, the demand for crude oil still exists, and the uncertainty of supply will push up crude oil prices, thereby improving the profitability of oil giants. Therefore, the energy sector is likely to strengthen against the trend today, but this does not mean that all energy stocks can be bought. We need to focus on the performance of core targets. Specifically, we need to focus on the performance of two oil giants, Chevron and ExxonMobil. These two stocks are the leaders of the energy sector, and their trends directly determine the direction of the entire energy sector. Today's opening, we need to pay attention to whether they can gap higher and maintain above the 5-day moving average. If they can gap higher with increased trading volume after the opening, it indicates that the market has high expectations for them and institutional funds are entering the market. At this time, we can consider following up with a small position. However, if they gap higher with low trading volume and quickly pull back below the 5-day moving average, it indicates that the market's buying pressure is not firm, which is likely to be a short-term speculation. At this time, we need to be cautious and not blindly enter the market. In addition to these two leading stocks, you can also pay attention to some small and medium-cap energy stocks. However, it should be noted that small and medium-cap energy stocks are more volatile and risky, suitable for short-term traders with strong risk-bearing capacity, and stop-loss must be done well. In addition, the trend of the energy sector is closely related to crude oil prices. In today's trading, you must pay real-time attention to the price trends of Brent crude and WTI crude. If crude oil prices fluctuate sharply, energy stocks will also fluctuate accordingly, and you must adjust your trading strategy in a timely manner. Next, let's look at defense stocks. The most direct beneficiary sector of the escalation of geopolitical conflicts is the defense sector, because the escalation of conflicts will bring more defense orders, improve the profitability of defense companies, and the market will front-run this expectation. Leading defense stocks represented by Lockheed Martin, LMT, have already risen to a certain extent recently, which is the market's advance reaction to the expectation of defense orders. But here, everyone must pay attention to a potential risk. The rise of defense stocks is completely dependent on the escalation of geopolitical tensions. If there is an unexpected diplomatic turning point in the situation, such as a reconciliation between the US and Iran or a mitigation of conflicts, then the market's expectation for defense orders will cool down. The profit-taking pressure on such stocks will erupt instantly, and stock prices may drop sharply. Therefore, in today's trading, while paying attention to the opportunities of defense stocks, we must do a good job in risk control and set a stop-loss level. Once there are signs of a mitigation of the situation or the stock price breaks below the key support level, we must leave the market in a timely manner to avoid being trapped. In addition to Lockheed Martin, LMT, you can also pay attention to other leading defense stocks such as Raytheon Technologies, RTX. These stocks have relatively stable trends and good liquidity, suitable for short-term traders. In addition, the rise of the defense sector often has a linkage effect. If leading stocks rise, other defense stocks will also follow suit. But if leading stocks fall, the entire sector will also be dragged down. You can focus on the trend of leading stocks to judge the direction of the entire sector. To summarize the core points of the third part, energy stocks benefit from the rise in crude oil prices, focusing on the opening performance of Chevron and ExxonMobil, which needs to be judged in combination with crude oil price trends. Defense stocks benefit from the order expectations of geopolitical conflicts, focusing on leading stocks such as LMT, but need to be alert to the profit-taking risk brought by the mitigation of the situation and do a good job in stop-loss. Finally, let's enter our fourth part, the trading manual and risk management. We will provide actionable operation suggestions and risk control strategies for today, helping you standardize your trading behavior, avoid risks, and improve trading success rate. Dear traders, no matter how accurate our market analysis and sector judgment are, what ultimately determines our trading profits and losses is our trading discipline and risk control awareness. Especially in today's market environment dominated by geopolitics and increased volatility, doing a good job in the operation manual and risk control is more important than anything else. Next, I will give you 3 operation manual suggestions for today, and I hope you can strictly abide by them. The first suggestion: patience, patience, and more patience. After today's opening, the market is likely to fluctuate sharply. There will be a lot of market noise in the first 10 minutes of the opening, such as gap down opening, rapid rebound, sharp decline, etc. These noises can easily interfere with our judgment and make us make impulsive trading decisions. Therefore, in today's trading, everyone must avoid the noise in the first 10 minutes of the opening. Do not rush to enter the market, wait for the first 5-minute candlestick to form, observe the real market trend and capital flow, and then decide whether to enter the market. Remember, in a market with large fluctuations, waiting patiently for a clear signal is more important than entering the market blindly. It is better to miss the opportunity than to take the risk of being trapped. The second suggestion: do a good job in hedging to prevent tail risks. In the current market environment, the biggest risk is the uncertainty of geopolitics, which may bring sudden market fluctuations, which is what we often call tail risks. The current VIX, Volatility Index, shows that market volatility is being underestimated. Many traders have ignored potential risks and failed to do a good job in hedging. Therefore, in today's trading, everyone must check their tail risks. If you hold a large number of risky assets, such as technology stocks and small-cap stocks, it is recommended that you hedge appropriately, such as buying VIX options or reducing part of your position to reduce your risk exposure. At the same time, do not engage in excessive Leveraged trading. Although leverage can amplify returns, it can also amplify risks. In today's volatile market, excessive leverage can easily lead to liquidation. The third suggestion, focus on the trend of the 10-year US Treasury yield. Many traders may wonder what the relationship is between the 10-year US Treasury yield and US stock trading. In fact, the 10-year US Treasury yield is the anchor of global asset pricing, and its trend will directly affect the stock market, especially the trend of the technology sector, Nasdaq. Because technology stocks often have high valuations and are very sensitive to interest rates. Once the 10-year US Treasury yield rises, it will increase the discount rate of technology stocks, leading to a decline in the valuation of technology stocks and thus triggering sell-offs. On the contrary, if the 10-year US Treasury yield falls, technology stocks may rebound. Today, due to the impact of geopolitics, the 10-year US Treasury yield may fluctuate. You must pay real-time attention to its trend. It will determine whether technology stocks will become the target of sell-offs and thus affect the trend of the entire US stock market. If the 10-year US Treasury yield rises sharply, it is recommended that you avoid technology stocks. If the yield falls, you can appropriately pay attention to the rebound opportunities of technology stocks. In addition to these 3 operation suggestions, I will add 2 more risk control disciplines for everyone, and I hope you can strictly implement them. First, set clear stop-loss and take-profit levels. No matter which sector or stock you trade, you must set stop-loss and take-profit levels in advance. Once the stock price hits the stop-loss level, you must leave the market decisively, do not hold fluke psychology, and avoid expanding losses. Once the stock price hits the take-profit level, you must take profit in a timely manner, lock in profits, and do not be greedy. Second, control your position. Today's market volatility is relatively large. It is recommended that you do not trade with a full position. Control your position at around 50% to 60%, leaving a part of the funds to deal with sudden market fluctuations, so that you can maintain initiative in the market. Okay, dear traders, the above is all the must-see content before today's US stock market opening. From the macro pulse to the S&P 500 technical levels, from sector games to the trading manual and risk control, every point has been deeply analyzed and disassembled. I hope it can help you. Finally, I want to say a word to everyone. The market never predicts the future, it only reflects the current pricing efficiency. Today's market is full of uncertainty. Every slight change in geopolitics may trigger sharp market fluctuations. But please remember, no matter how the market fluctuates, maintaining a calm mind, strict trading discipline and good risk control awareness are the keys to our long-term survival in the market. Do not be swayed by market emotions, do not blindly chase ups and downs, observe calmly, execute decisively, and do a good job in your own trading plan, and you will surely take the initiative in today's trading. Wish you all a smooth trading day and full profits. See you after the close. Disclaimer: this content is for educational and informational purposes only and does not constitute any financial advice or trading recommendations. All investments and trading involve substantial risk. Past performance does not guarantee future results. Conduct your own research or consult a licensed financial advisor before making any trading decisions.